Hello and welcome to the Primest Proposition Vodcast, here the Lion Roar. Today we're going to do something a little bit different actually, and instead of discussing with a provider something about their specific offering, we're going to do an educational vodcast and try and bring to life or de-jargonise some of the real life stuff that's going on in the mortgage industry right now. So I'm delighted to be joined by Adam Sheldon, National Account Manager for Kensington Mortgages. Hi Adam, good to see you, mate.
Hi, Matt. Pleasure to be here.
Good stuff. So I guess, Adam, before we get going, I know you, but maybe some of our viewers don't know a lot about you. So tell us a bit about you and your background, mate.
Yeah, thanks, Matt. Yeah, we go back a bit, don't we? Fellow Stokies, if you like. Yes, I've been in the mortgage industry for just over a decade. Some may see that as a bit of a novice, but I absolutely love working in the industry, really passionate about lending and advice. I find it really, really interesting. Hence why I'm in this position. So my main role is to look after our national account partners, which are networks and clubs and networks, just to make sure that they're fully aware of Kensington's proposition and help them with educations, introductions, that sort of thing. So quite a broad remit, but I absolutely love it.
Perfect, mate. Indeed, fellow Stokies, but not a Stoke City fan over this side of the water. So.
Can't have it all, mate.
There you go, mate. So, let's get going with some of the questions then. So I want to talk about swap rates, SONIA, inflation. You know, all these things have an impact on mortgage rates, and we're talking about them more than ever now. So if you as Adam were asked to explain to Joe Bloggs on the street how and why interest rates are fluctuating right now, how would you answer that question?
Well, thanks for starting with a really easy question, Matt. Yeah, it's a difficult one. It's something I have been asked in the pub. I also think mortgage brokers do a great job in answering this question. And there's certainly going to be brokers that are watching this that'll answer it more eloquently than me. I would perhaps kind of maybe answer it in relation to the expertise of the customer. There's certainly a lot of curiosity around there from the customer point of view. So maybe your answer will dictate who you're speaking to. But you've answered the question really within the question. So I would say something like, well, the path of inflation has a lot to answer for, mainly because it's dictating where rates are priced. So given the volatility in the market because of the pandemic fallout, supply chain pressures, war in Ukraine, etc., it's been really, really difficult for financial markets to predict where the path of inflation is going. And that's causing sentiment to change and therefore expected rates to change. Now it's the expected rate which dictates fixed rate pricing, which I think is what you're really getting at in your question. So by way of example to that, you could perhaps articulate the ONS announced inflation figures released recently. It dropped to 7.9 in June. I mean, that is still really high, but the critical thing is it coming lower than expected. So it's predicted to come in at 8.2%. Now that caused that expected rate, which is the swap rate, which you referred to in your question, that caused that to drop for the first time since May. And then we've seen lenders, mainly specialists to start with, but then other lenders start to decrease the rates, which is really, really positive. And of course, the opposite of that was true. And the previous inflation print was released. We saw them come in higher than expected, which then caused the markets to get a bit jittery and therefore fixed rate pricing to increase. Now, how swaps works may or may not be a valuable conversation for the customer. Personally, I think it's why do lenders engage in the swap? That's the important thing, because if lenders don't engage in the swap and don't price accordingly, they could have products out there which are essentially not making any money or unprofitable. And as a lender, certainly at Kensington, we will never keep a product out there. If sentiment moves and rates come up, we will never keep a product out there which is unprofitable. It's not sustainable. So we think for our sustainability and for our customers, that's the right thing to do. So a bit of a long-winded answer. So that's kind of maybe how I would address the question around market volatility and inflation. Inflation is public enemy number one, and it's the market sentiment and reaction to that. And it's really, really difficult for the markets to predict where it's going. And that's what's caused the volatility. Other reasons would include competition. So if you're priced lower than your competition, you may be inundated further than the capacity that lender might be able to cope with. So, you've got this weird situation where lenders, although they've got the capacity to lend and there's plenty of liquidity in the market, they don't want to be inundated because it affects their service levels. And also things like lending appetite in a certain area, for example. So you may be overexposed in shared ownership or a certain loan to value. So a lender may either pull that product out completely or just increase the rate of interest in order to price themselves out of the competition. So they've got their risk metrics all covered.
Yeah.
And the one area that's not been discussed, and there's a really long-winded answer, and I suppose advisors can take snippets from this, is lender systems. So their ability to pull a rate and reprice and then relaunch a rate, the time it takes for that to happen will be different lender to lender based on the systems they use. So we use a really efficient system. We and reprice quickly, which allows us to stay profitable. And you'll often see us go early on both, when rates go up and down. But some lenders' behaviour may be dictated a little bit by the systems they use.
Perfect answer, mate. And, it wasn't too long-winded because actually everything you've said is really relevant. And I guess that profitability piece, no one in any business would run a business without making a profit, right? And we,
Exactly.
those of us who've been in the industry for a long time can remember 2007 when the market crashed. We can remember NatWest and RBS getting bailed out by the government, and nobody wants to go back there. So I think you're absolutely valid with your points, Adam. Thank you. I think so, a further education piece while we're kind of on this subject is what Amy have produced. So they've produced a lending funder guide that I think really helps clarify the motivations and constraints that lenders are operating within. Some of that stuff you just talked about there. What are your thoughts on that document from Amy, and what do you think brokers should do with it?
Yeah, I read it front to back. We contribute to the content, so I'm going to be really biased in my answer and think it's a really, really useful document. I think, it's not my place to say what brokers should and shouldn't do with it. I certainly feel that some of the content's really useful, and brokers have a wide ranging of experience. I'm a national account manager, relatively new to the role, and my experience will be different to other national account managers, for example, and other people that work within lenders. And the broker community is no different. I did read a stat the other day that 70% of mortgage brokers haven't experienced a rate rise before. So although there's a lot of experience in the market, there is some relative inexperience. So I would say I'd encourage everybody to read it first of all, and then those that think it's really useful, think about how you can use that to explain maybe that first question you've asked me to the customers and other inner workings of what's going on in the industry. And maybe you could use some of it to inform, articles that you may want to host on your website, customer blogs, should I say, communications, etc. Because like I said, there's that thirst for consumer education. And if you're on the front foot explaining what's going on, you're going to be really, really knowledgeable, and you might win that customer, for example. So I would say use it as you see fit, but definitely take the time to read it.
Yeah, totally. I agree. I think it's a great document. And, whilst some brokers may go, it feels quite basic, I think that's what clients need, right? And I think that basic language, if everybody could get their understanding to that level, clients would understand it better. So I can, I'm with you, mate. I think it's a cracking document.
Absolutely. And like you said, what it does a really good job of doing is explaining things which can be quite complicated in a simple way, which I think is really important.
Yeah. Totally, mate. Good. So we'll go a bit more in depth then. I'll give you another cracking question. I'll get you talking about capital markets, mate. So you and I caught up a couple of weeks ago, and I think we had a really good in-depth chat about what's going on in capital markets right now. So again, if you were to talk to a brand new mortgage broker about what's going on in capital markets, what are you saying?
Thanks again for the easy question. Yeah, I mean, we're quite fortunate at Kensington. We have a very talented capital markets team. We were, I guess, one of the biggest securitizer in the market for the last sort of 15 years or so. So I had a good catch up with the capital markets team before my holiday last week. there's different ways you can answer that. I mean, one thing that they're seeing is there's what they call more prime issuers, so more of the bigger boys and girls coming into market, and they're raising funds to pay off the government funding for lending scheme that was launched in the pandemic. So that's really interesting. But I suppose what's going to be interesting to the brokers that are watching this is around what's going on with securitizations. So if you think that 70% to 75% of the market are funded via retail deposits, so savings, etc., there is still a big chunk of the market that is funded by the capital markets, and specifically securitizations. So that's really, really important that is happening, and there are specialist lenders that are going to support more specialist customers. So I suppose what might help to start with is just to define what a securitization actually is. Now, I know brokers might be thinking, oh, here we go, but really, really quick definition, just in case it's helpful, because it might frame my answer. So as a specialist lender, if you just funded via the capital markets and you're going through a securitization, firstly, you need some money to lend out. So what we would do is we would get essentially a big overdraft facility with the retail bank, so say £100 million. We will then need to lend that out in the form of mortgages. Now, the bank, for example, would want that £100 million back in, say, 12 months' time. The problem is mortgages are repaid over 25, 30 or 40-year terms now, as mortgage advisors know. So how do we bridge that gap? We set up an SPV. We bundle those mortgages together. We take that to investors. They get rated. So if anyone's seen The Big Short, we've always dealt with sort of AAA. We use data to inform a lot of our lending decisions. So they're sort of really, really good mortgages, etc. So they get rated into an SPV. They go to an investor. The investor takes a cut of the monthly payments from the customer. The specialist lender takes a cut for their profit and overheads. And that money raised then pays off the overdraft facility, and the whole process starts again. So if you think about mortgages and housing as a really, really stable investment, before the last sort of 3 or 4 years of all this turmoil and volatility we've been going through, mortgages and housing has been seen as a really, really lucrative deal for investors. Regulation change, obviously limited company buy-to-let, etc. Loads of reasons for it, the rise in self-employed, etc. What we're seeing now is we've talked about the spreads and being a cost to a lender, the swaps, but there's also something called spreads. So we're seeing those spreads widen. So that is the cost in order to securitize. So when we go to the investor, they essentially want more money to take in on more risks. If that makes sense. So in periods of higher risk, which is what we're seeing now, those spreads, so the cost to secure that money is actually wider. That's gone up. So to give you an example and put it into context, pre-pandemic spreads are around 0.75%. They're now around 1.25%. So as a specialist lender, you've got that additional cost on top of the swaps, on top of the operational costs and any costs factoring risks of that mortgage not completing, for example. So what are we seeing? We're seeing probably a greater divergence in pricing. So those lenders that just securitize as a model, they have to price at a certain rate in order to stay profitable, which is why you're seeing those lenders price a lot higher than maybe those that have got retail options, so savings rates, etc. So we're definitely seeing that. We're also seeing less securitizations happen. They are still happening. There is still, the good news is, there is still investor appetite. Obviously, they get more money for their investment. But there are about 40% less securitizations, which seems like a lot and is a lot. But what I would say is that is reflective of the overall market. So if the overall lending market is 40% down, so from the specialist funding perspective, it is just reflective. So that's another way of looking at it. So what might happen next? Well, as a result, lenders are looking to diversify their funding models, as well as maybe going up the risk curve and moving into different areas that they haven't done. So you've kind of got this diversification of the back end, so how they're funded, but also that diversification of the front end, so criteria. So as an advisor, looking at different systems and staying on top of the criteria is really, really important. But what's happening behind the scenes is interesting in the sense that lenders will be looking at, okay, can we get more funders? Can we maybe get retail license? So do we become a bank essentially? That gives us more breathing space where we can, not just reliant on one funder, for example. And you might see more consolidation in the marketplace. So of course, we sold ourselves to Barclays, which is great for customers. We have a really diverse funding model at Kensington, where we can plug into their current account lending. We may securitize to offset risk from time to time, and we've got a long-term fixed rate product which may be more prevalent in the market in the future, and that's actually funded by a pension provider that are looking at long-term investments, etc. So that's more stable. So we've got a really diverse funding model, and I think you may see specialist lenders try and go down that route. Hopefully the rates coming down, which you've seen recently, we'll continue to see that pattern, because that's really, really important. Because the problem you've got is with those additional costs I've mentioned, those spreads, those swaps, you can only price so cheaply. So the higher your price that you're offering a customer, that's going to affect affordability and the potential desire of that product. So I think it's really important, because nobody wants to see any lenders go underwater, for example. So I'm hopeful that, we're in a good place, because the long-term picture is really healthy, and the specialist lending market, I just can't see anything other than growth. But we're on this interesting point where funding is a challenge, but we've got so many drivers, which will mean that lenders like ourselves and others will be really, really important for advisors and customers as we come out of this in the next sort of 6, 12 and 18 months.
Yeah, agree, mate. And, I agree with the point. Nobody wants to see anyone go underwater, right? The more lenders we've got on the pitch to help clients, the better. So definitely agree with that point. Good, mate. Thanks for that. I'll move on to the mortgage charter now, which is very topical in our industry at the minute. So, it was great to see the government get involved, and then, off the back of that, to see the lender take up and see how many people signed up to it. I'll give you a Kensington question and then add the wider market to it. But what does the charter mean to Kensington, and then what do you think it means to the wider market?
Yeah, I mean, I guess being part of the Barclays family means we get early insights of these initiatives. We were one of the few specialist lenders that have signed up to the charter. It does give some clarity and options for customers. A lot of the initiatives from the charter we were doing anyway, so it was quite straightforward for us. I guess for the industry question and answer, and I guess a personal view, not a Kensington. I often think that nothing is ever completely good or as bad as it seems. Yeah. So there are maybe some unforeseen consequences of it. So if you look at some of the initiatives, giving clarity for customers in terms of repossessions, 12 months. In reality, it would probably take 12 months anyway, but to give that clarity for customers, probably positive. Interestingly enough, today, I don't know when this is going to be launched, Matt, but on the 1st of August, is this month, today, as we're recording it, the government have launched some free legal aid as well for customers that are in that position. So brokers, if they are coming across those customers, we don't expect there to be many, but you could signpost to the free legal aid that the government are offering. Right. The other parts of the initiative around the customer being able to lock into a product transfer 6 months before and then jump onto a new rate if it's cheaper at any point up until expiry. From the customer point of view, that's really good, because it acts as an insurance policy for the customer if rates go up. And if rates fall, then great, we can take advantage of it and make a saving. I do worry about the multiple rekeying that's going on for advisors. Advisors are busy enough anyway. There's a lot of rekeying that's going on. So what kind of toll will that take? I don't know, but it's that could be that could be a potential cost to advisors, the extra time it takes to do the multiple rekeying for essentially one smaller prop fee. And the other measures around 6 months and interest only and term extensions. There's a question around, is it long enough with rates expected to be longer? I think it's good that the government are doing something, or being seen to be doing something. Can lenders' systems handle it? I don't know. From our point of view, we can. It's live, we're ready. But should customers be seeking advice first from the intermediary community? And again, is that a bit like pro bono work for advisors? So I know advisors want to be there for customers, but there's already an income challenge and already stress levels and a mental health challenge. And I do wonder what the added pressure of it may give to advisors. But overall, I think there's a balanced picture to be had, but we're proud to be part of it. And I think it is right to obviously support customers who are in difficulty.
Yeah, good. Thanks, mate. So Going to talk about Martin Lewis now. So love or loathe the guy, and I won't give my views on a recorded podcast.
Go on.
No, but he interviewed the Chancellor, didn't he, recently on ITV, and it was also really good to see that there was a mortgage broker on the show answering some of the really technical questions, kind of like what I've done today, mate. I've got you on on here to answer the technical stuff. But I guess what would you say was the key thing that you took away from Martin Lewis when he sort of put that out to ITV?
Yeah, I mean, I guess there was a few ones, a few key points I would say. I mean, I agree. It's great to see a broker on there. Obviously, typically signpost people to, the money supermarket site, etc., comparison sites. But given the complexity, he is starting to be an advocate of advice, and having a broker on there represented the broker community really, really well. I hope that his audience, and he has got a big audience, starts to have a growing perception of mortgage brokers and actually getting that independent advice, because there's lots of choice in the market. There's this kind of obsession with average rates, and I know we play a part of that being a specialist lender, but it's often cheaper rates than the average and things like that. So I think hopefully customers will pick up the phone and speak to a broker off the back of it. So that's one thing I'm hopeful will happen. It was an emergency show, so it does show the relevance of mortgages. And there was some really good stuff, actually, which I know mortgage brokers do really well in terms of getting mortgage ready. So we talked about getting prepared. That hand-holding piece from an advisor, I think, is really, really valuable. So we talked about if you're on a low fix now, think about overpaying or putting some money in a savings account so you can absorb those extra costs when you come off. So there's lots of things you can do as a customer to get ready if you are in that position where your rate is going to go up. So I certainly think as an advisor, they will be doing this anyway, but over communicating, contacting the customer earlier in the process, talking about what the options are and looking at some of those things, I think is really, really important. You mentioned the Chancellor interview. I don't think there was any surprises in the answers he gave. And my take was basically the priority number one was to not get in the way of inflation, tackling inflation, trying to get that down to 2%.
Yeah, totally, mate. Good. So that sort of all brings me into the last question quite nicely. And I think you just articulated some of that in the answer to that question. I keep talking about the rise of the mortgage broker, and, that's bang on with what Martin's done there, getting a broker on and starting to shift his own views from Money Supermarket, as you just said. So, everything we've talked about today really points to one thing: clients need brokers more than ever, right? And clients need advice. So do you believe that the awareness of the intermediary world is growing? And what more do you think brokers, lenders, networks, any industry colleague really could do to raise awareness, in terms of what's on offer by our industry professionals?
Yeah, thanks, mate. Interesting question. I think the answers open up more questions. I certainly haven't got all the answers. I think the intermediary share has been growing. If you look at what's available to customers, the high street, they might not have a high street bank anymore. The world is getting more complicated. Customers are getting more complicated. If the customer does go and get through to the high street, they may get more declines. So I think Imola predicted that the market share would grow, and I actually agree with that. So I do think the opportunity in this tough time, if you like, would be for intermediaries to really sort of grab it with both hands and do the best to grow the market share. I do wonder if there is I guess more to your point around the question, as I do wonder if there's a perception gap and an awareness gap from customers. I did see a video on LinkedIn from a protection provider where they interviewed a bit of the general public on how familiar they were with terminology in the financial services. I'm not sure where it was in the country. It was quite an interesting video because not all the customers knew what income protection was. So they're just general people just, going about their day. And if you just sort of reverse the question, what is income protection? What protects your income? So that was really interesting. I just wonder whether it's the truth can be said for mortgages, possibly in some instances. So how do you address that? I've seen some brokers that do some great work in schools. They work with local businesses. Can you be the go-to person for education and a voice in your local area, perhaps. I know Primus do lots of stuff with their ARs around engaging in this type of stuff. I'd be certainly curious about changing demographics and where customers get their information from. In my previous role, I used to look after accounts, and their phrase was, we want to meet customers where they want to be met. So if customers want to engage online or via social media, are you fishing in the right area? So maybe be curious around that. But also, I think if you're going to do something, and you just do it really, really well. So I remember when Spotify came out and everything was all about downloading music. There was a counterculture happening. There's a rise in vinyl. Yep. So I have seen brokers open on the high street where banks have maybe left. So I think if that's your model and you're a word of mouth broker and you're very active in the community, then maybe sort of, engaging in the social media might not be for you, but actually going against it and just doing what you're doing really well and having a presence on there on the high street might be something to consider. But whatever you do, I think you've got to do really, really well. And I guess last thing, this is a biased answer, would be, focus on specialist lenders, and there's lots of lenders out there that can help. We've got our webinar series, which are all available to watch. We have, shameless plug, we've got one coming up on 12th of September, which is actually unpacking some of the questions you've asked me today as well. So by all means, check that out. And obviously our BDMs are there to talk about maybe how to read credit reports, all sorts of stuff, which will give you that edge when you're talking to customers. And then can you use that in your communications? And maybe think about marketing to those customers where we know that they feel it's harder to get mortgages. So like the self-employed, for example, could you sort of reach out and say there are options? We know lenders that when you're self-employed, etc. So yeah, it's quite a long-winded answer. And I do also wonder, there's lots of work going on around the Green Initiative, around diversity and inclusivity. So getting more variety of different people with different backgrounds, thinking about sustainability and what that might mean for the industry. I think there is an opportunity there to also raise the awareness of what advice can give. So there's lots going on, but I do think the collaboration piece is really, really important in order to sort of unpick that question and actually come up with a more succinct and eloquent answer than the one I've just given.
No, that was good, mate. I've got some personal views on it, and I think, if I think about when we go to an industry event, right, there's 100 people who work in this industry. We all know what we do as day jobs in that room. But if you went and spoke to friends and family of those 100 people in that room, how many of them would be really clear about what we do for our day job? And I think, the amount of people I speak to where they go, my wife doesn't really understand what my job is, or my husband doesn't get what I'm doing, that's our responsibility to educate. This is what our industry is. This is how we can help customers. And actually, don't just walk in direct and see someone because you're going to be offered one product tied to one person. So I think just little things like that are helpful, aren't they? I guess there's loads of things you could do to shout about. One, what a great industry this is to work in, which you and I firmly believe because we've talked about it before. But then secondly, those brokers who are doing a cracking job out there, actually helping customers, one, achieve the dreams, two, save some money, and just have a financial person who's your go-to who can help you out with stuff that you might not understand. I think it's as simple as that, isn't it, really?
Yeah, and I think there's a short-term and a long-term view as well. I think if you look at longer term, I think, could we have a more, a better market once we come out of this? I guess reputations are made in tough times, and we may see some advisors leave the industry. We may see a lot of advisors become more rounded advisors because they're looking at different solutions. We may see lenders come up with different types of solutions for customers where their needs are changing. So we may get a better industry of, off the result of this. I mean, in the short term, people are really anxious and worried. So I suppose, how can you deal with that? Because you're imagine it's really stressful as an advisor to have those conversations.
Yeah.
Then you've got to get on with your own life, and you might be financially impacted as well. Totally. So the customers that find it difficult to talk about their finances, we know how that impacts mental health. So what can you do as an advisor to support those customers? So yeah, short term, there's some challenges ahead, but long term, it's something to really think about. It's an interesting question.
Yeah, agree, mate. Cool. Well, listen, I've kept you for long enough today, mate, and we've already said that it's the 1st of August, so no pressure on the Primis team to get this video out ASAP, hey, to make sure it stays relevant. But thanks for joining us, Adam. Some really useful stuff there. I think it's been good to just have a educational chat that doesn't just zone in on a specific product. So I really appreciate you taking the time to talk to me today, mate.
No, pleasure. Thanks for having us.
No worries. Take care.